Welcome back to our Structured Products Roundtable. We're continuing the dialogue from the first session. We're going to talk about the structured product space, securitized assets, and what some of the potential opportunity sets are, what some of the pitfalls are, and how we got to where we are today in the fourth quarter of 2020. So, Ken, you've been very vocal about the differentiation between traditional credit, things like corporate bonds, and structured credit. We have a booming housing market. It's advantageous. Vitaliy had mentioned something in the previous segment where he was talking about Fed intervention and the Fed playing God, I think he called it. How has Fed intervention impacted your market? We know how the administration allowed the forbearance to help the homeowner, but how has that impacted the structured products market with the Fed's intervention in various public markets?
Yeah, I mean, I think, I don't know who mentioned it, maybe Vitaliy, but it's, the things the Fed buys, the things the Fed doesn't buy. And they definitely came in to support some parts of the market that they historically have, especially the higher grade AAA portions of the market, asset-backed securities, some CMBS securities, some CLO securities. So there was a set of criteria that they came up with. But broadly speaking, what you saw coming out of March and April was the things that the Fed bought, they came back first. And then the higher up in the capital structure you are, the less uncertainty you have to losses, right? If you're the AAA, pretty sure you're not going to take a loss. But as you go down the capital structure, there's more uncertainty. And as you go down this capital structure in pockets of the market that are more affected by COVID, like CMBS or parts of CMBS, like parts of transportation, you're even more depressed. So there's a couple ways you can play that. So the first thing you can play is just the things that the Fed doesn't buy have remained a little bit wider. So corporate bonds, investment grade corporate bonds, they've retraced probably around 95% of the widening that they saw during March and April, whereas on average, spreads at the higher part of the securitized market are still wider than they were in January or February. So there's still upside there. It's not a lot, but there's still upside. So on average, in the structured products market, you're still getting paid more spread relative to corporate bonds than you were at the beginning of the year. And then if you want to play this kind of recovery of eventually the market's going to open, the economy is going to open up back more, up more, then you can go into some of these parts of the securitized market down the capital structure, take more risk, clearly, but there's a lot more upside. And if you're in the housing sector, the spreads aren't as wide as, let's say, CMBS because the fundamentals are a little bit stronger, still cheap on a historical basis relative to where spreads were. And if you want to take a little bit more risk, you can go into places like CMBS, parts of the ABS market, and you can play that cyclical upside.
Right. So I hear about the idea of there's parts of the market the Fed got into, but even thinking about the corporate bond market, right? The Fed hasn't been a really large buyer. Yes, they set up the path to be able to do it. They set up the facilities, and it was more of just the idea that they can do it that brought confidence back to the market. Sam, we saw this in your space of the securitized products that are credit sensitive. CLOs seem to bounce back the quickest. So given Ken's comments, how are you thinking about different parts of the capital structure in CLOs today? And has the juice been squeezed out to those dynamics that Ken was discussing?
For the most part, the CLO market did recover pretty quickly. I think that was an extension of the indirect effects of the Fed, as you're describing, moving into certain parts of the market, sort of saying they'll do whatever it takes. And like if you drop a rock in the water, there's these concentric circles. The top of the capital structure recovered quickest, and then sort of stopped. And still today, parts of the market that are the most price distressed are the ones that have the most risk still. So it might be a CLO that has a lot of exposure to movie theaters or cruise lines. I think we were very active in the months from, call it, March to about June, picking up the pieces, I think, of the price declines in the CLO market. And we were looking at AAA is the very top where we could buy things, buy securities at very cheap prices, and then those prices recovered, and then so on and so forth. I think as we sit here today, for the most part, I mean, prices, we're recording this as we record this, prices are a little bit weaker over the last couple of weeks. And we haven't been a whole lot active. I think, my thinking is there's just some macro headwinds. I think CLOs are very much a macro product. And so we've been sort of picking the pieces of little parts of the market, single A's and triple B's, which are the rated classes of the CLO market. And I think on a go-forward basis, we generally want to try to buy securities at a discount. go into nuance of the CLO market, CLOs are generally callable, so somewhere above par, securities aren't going to go much higher than that. So what you really want to do is buy discounted securities. And so for now, we're sort of looking at parts of the market, like I said, single A to triple Bs, but we're really looking forward to the potential for some more volatility in the market. Probably from the macro, I don't expect it to be as severe probably as March, April, at least in the CLO market.
Can you give me a comparable of those single A, triple Bs, how those yields look in your profile? I know they're not directly comparable to the investment grade corporate market, but can you tell me kind of how the yield dynamic looks relative to those traditional corporate bonds?
Yeah, a single A, usually we talk in spread. I won't use that language here, but single A CLOs are yielding about 3.25%.
Okay.
And triple
against
Bs,
the corporate bond market, which is inside of 2,
yeah,
right, on
that's
the single
right.
A's
Yeah,
today, right?
Yeah. And triple Bs are about 4 to 4.5% for triple B CLOs. And that's probably 150 basis points or 1.5% inside of a comparable corporate credit. I do want to say that I think over the long run, CLOs of the same rating will trade wider than corporates. I mean, if you think about your average retail investor, they know what a GM bond is. They don't know what CGMS 2013-456 CLO is, and that liquidity premium is something that we always try to take advantage of, and there's a little bit of complexity there as well. So I'd be surprised to see CLOs trade exactly where corporates are, but they still are trading wider than their historical ranges. And I think that's largely a function of the Fed sort of explicitly saying that they're buying corporate bonds.
Yeah. Now, Morris, when I think about CMBS, Vitaliy had pointed out that the Fed's playing God, right? And that they chose not to buy hotels. They didn't explicitly do that, right? Again, not to derail what Vitaliy said. But really, they didn't really want to participate in the securitized market. I heard the rationale being that they couldn't take a loss. And then all of a sudden I'm like, but Mr. Powell, you're buying high yield ETFs. There's going to be a default in there, right? As we've already seen already. So walk me through kind of your thinking about CMBS. Why do you think it was excluded there, given that it is so, the economy is dependent upon commercial real estate? Is it because the levered players, the PE players? What do you think that is, and how are you trying to take advantage of that?
Sure. So, I mean, specifically what the Fed did for our market, the non-agency CMBS market, was that, they essentially created a program where they can include collateral that are rated AAA. And these are bonds that were issued pre-March of this year, right? And specifically in the conduit market. And these AAA bonds, they are very well protected. There's even through the global financial crisis that we experienced 10 years ago, these bonds were sound. And so, that notion that, the Fed provided this backstop for the CMBS market, they felt that that was enough. And, the concept, when we were, a lot of us were kind of scratching our heads a little bit, and also, thinking, how come they didn't want to support, what about, bonds that are rated less than AAA. But the word is, and we did hear through grapevine that yes, clearly the Fed didn't want to take on any sort of potential losses. But the explanation in itself, as I kind of dug into it, and the more you think about it, commercial real estate owners and operators, they are, in my terminology, they're astute professional investors. They are, some are well capitalized, but it's a big boy market, right? You have PE funds, you have billionaires, you have family offices that own these type of buildings, and so the notion of wanting to bail out this industry as a whole, it's less of an urgency than perhaps the residential market or from a population sort of perspective. So that sort of psychology and thought process leads to, at least for us, the rationality that you're not going to get bailed out, all right, clearly. So you're on your own. What do we do? As we're kind of thinking about our CMBS market, as we touched upon, there's areas that we can gain exposure to. It's by property types, by geographic locations. Then there's also different types of, there's also a different type of CMBS security where, there's a pool of commercial real estate loans with varying degrees of property types that you have some diversification. But at the end of the day, when we're thinking about structured products, the benefit of this is you can, look through depend on one side, the structure, to rationalize where do you want to play in terms of the capital stack. We'll just use ratings to describe the capital structure. AAA, safe bond; BBB, less safe bond. And so, as we're thinking about the capital structure today in today's world, there's varying degrees of prices. There's also varying degrees of price recovery as we experienced in March. Where we think there's a lot of value is bonds that are what I would describe as belly of the curve. These are AA rated securities or single A rated securities off of commercial mortgage transactions that are diversified. So there's a pool of 50 to 60 different loans, different property types underlying that, and through the structure you can withstand little cuts or death by 1,000 cuts. And as long as from a structure protection perspective, you're protected, irrespective of what type of defaults comes through. At a certain a bond rating, you're able to be insulated from losses. So there's a reason why we like this belly of the curve sort of capital structure type investments. If you're thinking about taking on more risk, clearly there are opportunities there. The below investment grade or BBB type rated assets, which today's world we call it the fulcrum tranche, or the tranche that most likely may have a higher chance of experiencing the first dollar loss within the structure. There's definitely opportunities there too. But it's a very security selection sort of world. And taking a bigger step back, the CMBS market, this is a market where the recovery from coming out of the pandemic, it's not going to be uniform. Every deal has their own inherent underlying unique type of risk profile. It's not a simple trade to put on, and the dependency in terms of myself and my team members is on my team members, and collectively through our collaboration be able to assess each individual loan, what's going to happen to this loan. Is the asset worth a certain amount of dollars? Is the intrinsic value of the underlying securities at the end of the day worth more from an intrinsic value sort of perspective? So that's how we are thinking about the world. There are a lot of unique opportunities in our space, but I would identify that as it's a security selection world.
Right. So you're not trying to do a thematic macro trade here, what we call a beta trade in portfolio management, but you're really looking for those idiosyncratic ideas as well. It's at least on the risk-taking side. So Andrew, Morris is talking about billionaires, and there's not the ability to bail that out. Some of the asset-backed market has experienced the same idea, the Fed support on the AAA stuff. But I kind of view, just listening to Morris's comments, transportation as being very important. These energy companies being important to us, whether it's alternatives, renewables. So why isn't there the same type of kind of bailout, since that's what we're talking about, for your space as well?
I mean, you look at the market, and again, the ABS market is so diverse. There's no direct bailout of necessarily consumer-backed bonds. They're not buying, different credit card issuers, so forth and so on. But what they are doing is essentially helping the consumer out through these stimulus programs, right? Whether it's the payroll protection program, whether it's enhanced unemployment benefits at the state level, that is indirectly helping out these consumers, and therefore they're able to make their pay their obligations, which is reflecting in the securitizations. So although there's not this outright direct buying of some of these assets, they are benefiting in an indirect way. Now, some of these other areas you talk about, and I would characterize them as more of the hard asset type areas. Aircraft are not being helped, but what is being helped is airlines on the corporate side. So there has been targeted relief provided to some of these airlines, and that is indirectly also benefiting us. So, these are key key sectors of the market. In some ways, they are very important for our national security as well. So those are being helped, and indirectly because of that, our securitizations are being helped. Now, if the question is where's the opportunity set, I wouldn't say that only everything falling away from those sectors that are being helped would be the opportunity, because some of these sectors, because they're not seeing the direct buying from the Fed, there's still pretty attractive yields and spreads available there. And I would say that if they're going to continue to provide this passive assistance, it may bridge the gap to help some of those mezzanine bonds recover. And there, you're really levered to this recovery where the returns could be astronomical. So a lot of interesting things going on in these different sectors. But I would say you can't just say, since this sector is being directly held by the Fed, the opportunity set's not there. There are other ways to make that play.
Right, and I think that's what's important too. There's a lot of headlines that you would think reading the headlines, and as Ken sent you a story today on that, Morris, that all commercial real estate's toxic, and all agency mortgages are good. But let's talk about what you brought up here, that there's this indirect behavior. And Ken, why don't you talk a little bit about how you're thinking about the dependency on these transfer payments from the government, whether it's through the PPP, as you'd mentioned, or if it's enhanced unemployment benefits that are set to expire, right, in the near term. And so how are you thinking about that, given we've had this strength in the housing market? How dependent is your analysis on those type of ideas?
Yeah, I mean, that's a data point. We talk about looking at the data a lot. I mean, we've been really monitoring month by month to see how things change in the underlying performance of a lot of the consumer receivables, whether it's credit cards, auto loans, student loans, mortgages, or payments on multifamily would be another one. And definitely we're waiting and watching to see if those numbers go up, right? I mean, I think there's going to be another fiscal plan. I'm waiting for the next Bloomberg headline. It tells me what time Mnuchin and Pelosi will get together to talk. That was a joke, I guess a bad one.
Yeah. Today's headline was that Pelosi said she's waiting for him to get back to her.
I thought she wrote like a letter to him.
Yeah, I don't know. It kind of is like the 3-day waiting on the first date. Like, I like you, I'll call you back or something like that. I don't know.
But look, I think delinquencies will start creeping up. And in the residential space where we've seen them start to go up is you can look to see what delinquencies are by loan balance, right? And people that have a lower priced home, they're probably more blue collar and job. You've seen more job losses in that side, people that work in retail and hospitality and some of these harder hit sectors. So they've already started to creep up. You just have to kind of wait and see if more stimulus comes. But depending on where you are in the capital structure, you don't really need to worry about it. If you own the AAAs or the AAs or the single A's, I think you're in a pretty good spot. And even if you see delinquencies creep up, you're not going to get hit. Even in some securitizations, down to the below investment grade, there's enough support. There's enough what we call excess interest that the cash flows are pretty stable. So it's case by case, but I think most securitized structures, because of what Sam talked about, the rating agencies got way more conservative. So for the same rating, in some cases, you have double the credit enhancement that you did during the last financial crisis. On average, underwriting, especially in mortgages, both residential and commercial, is better than it was pre-crisis. You've got new regulation under Dodd-Frank called risk retention. So people that package this stuff up can't just sell it, package it, sell it. They got to keep skin in the game. They got to own a certain percentage. So there's a lot of things that have made these things safer, and I think that's going to help. Even if delinquencies go higher, I think that safety will still be there, and I think it's an interesting spot for investors to look to.
Yeah, you brought up an interesting point too, is the collaborative effects, looking across people's markets, right? And I'll put this out for any of you to touch on. How do you guys interact with one another? It sounds like, when you were talking about this, they seem very siloed, but you're using information from each other's sector. So maybe Sam, how do you think about what Andrew's telling you about his space, and Ken and Morris? How do you pull this together to think about the CLO market? And I'll let everybody kind of collaborate on that.
I mean, I think it's an iterative, constant conversation where there's reference points that keep getting upped. So for example, if Andrew's talking about an opportunity set in the aircraft ABS market that's rated single A, and not necessarily that rating to rating has to be just the absolute criteria, but it's having a regular conversation with Andrew, and Andrew saying, okay, here's aircraft, 3 weeks ago it was here, and at that point CLOs were here, and now we're talking about it, and we're looking at those moving pieces And so I think it's really just this constant conversation and assessing relative value and relative risk. I mean, we're talking about some markets that have explicit Fed support, like the corporate bond market, and then there's others that don't, and there's others that have indirect support. So I think it's a conversation that has to be continuous, whether we're on the trading desk as before or doing this via software and Zoom and Teams platforms. I think it's really just this constant conversation and knowing enough as when we wear our generalist hat that we know what that means when Andrew says this, and sort of we ask questions of each other. Andrew, where's XYZ? And Andrew asks me where this is at.
I mean, I think I would say this is that the ABS market's so broad. It's difficult to say, hey, we're only looking at student loans today, or we're only looking at like telecom assets. For us, every day is different, and there are different assets coming in. And having these gentlemen here next to me is tremendously helpful because we do talk all the time. We have 2 formalized meetings a week, but at any point in time, I can dial any of them up and say, hey, this is what I'm seeing. This is what it looks like. Here's a risk. Here's our return. Like, how does this look versus your market? And that goes back to Sam's relative value point, which is really helpful. I would say the other aspect that's tremendously helpful is having access to the rest of the firm. Like for us here at ABS, when we looked at that Hertz transaction, we had never invested in a rental car asset back before, just because it was not interesting. Now, when they were trading, 600 spread or 800 spread, became real interesting. So we looped in the corporate guys and said, hey, what are you guys doing in the rental car space? What does that market look like for you? What is your relative value? And then we did our analysis in terms of, if things just go sideways from here, what can we recover here? So having access to the team here is really helpful, but having access to the entire firm gives, and I don't want to speak just for myself, but I really think the rest of the team, really good perspective on what's going on in the entire market.
I'm going to try to pose a question to get Vitaliy in the loop because we've been talking a lot about credit. But one of the things that I don't know if that was a good idea.
Do you want to change chairs? Do you want to sit over here?
Actually, sorry, can I just actually just jump in?
Go ahead,
and add
Andrew.
one thing?
Yeah,
So-
we're going to cut out Ken now.
Sorry, apologies for jumping in. But one thing that we actually like to do as well, because we do know the agency guys hate credit. They hate it. Like we can serve them something on a gold platter and they're going to hate it.
Right. It has risk.
It has risk, yeah. So we always actually bring in one of their team members or maybe a few of their team members into our credit discussion when we're talking about a new idea. And they may ask some really great questions. They may ask some off-the-wall questions, but if we can't answer them, that means we haven't done enough homework. So, inclusion of the agency team into credit work is actually a really important aspect that I've forgotten. Can you remind me? So
I think if sorry, Ken.
No, go ahead.
I think looking at everything here is we have this unified framework. I think in the previous episode I mentioned that upside downside base case. I mean, you can apply it to everything, right? And I think that's what we've been doing, whether people acknowledge that or not, is that when we discuss the Hertz opportunity, right? The first question I ask Andrew, what's your upside? What's your downside? What's your base case? How does it compare to what Sam sees or Ken or Morris? But not just that, is having, because you have, having good potential stories, right? It's a great thing, but also how it all plays together. Okay, I will, he's gonna tackle or block, and I'm gonna do the other thing for him, right? Basically, how it's gonna fit in together with the portfolio story, right? What are we doing in the other parts of the portfolios to compensate for, let's say, additional risk that he takes on, right? We're all sitting here, and we're kind of saying, Hugh, things are kind of back to whatever normal, right? But back then, it wasn't clear, just like in 08, 09, that things are going to go back to normal, and there's a lot of gloom and doom. And to have this ability to have that framework where I can say, well, you're increasing this side of the equation from the risk standpoint, I'll compensate you for that. That's a very important function of that framework.
Well, how are you compensating for that?
Well, there's many ways to do it, right? As we've talked about, having an exposure to, let's just say a simple thing would be just not to be coy about it. Let's just say, as I've suggested, it's often the case that, Fed's first reaction would be to cut rates, or market will buy safe, treasury instrument, therefore bring the yields down. Well, if I have an exposure to that part of the equation, if his things are not working out, actually potentially could hedge you. And we talk a lot about this barbell approach that we utilize in many instances. So again, there are many ways to compensate for it. And certainly that allows for a little bit more of risk taking when perhaps risk taking is not in vogue.
Right. So that's what I was about to come to before Ken wanted to take over the role here. But what I was going to say is, how do you guys as a team? I know we've all been working together since prior to the financial crisis, and this is our second crisis together. But how can you describe how we work together? Like how you guys are thinking about buying credit, buying rates, putting this together, because you've talked about, Morris, inside of your space, there's geographic diversification, there's property type diversification, the asset-backed world, there's all kinds of different exposure, whether it's to the macro economy, whether it's to the end consumer. CLOs tend to be a little more macro product than there. So how are you guys building portfolios together? What is part of the dialogue in thinking about structured products? Because you have your own internal diversification, then we're talking about credit diversification, and then we'll lead into Vitaliy help bringing in some rate diversification. So I'll throw a jump ball out there for whoever wants to start that conversation.
I mean, I think it goes back to, we all worked together, I don't want to say for our entire careers, but for some of us, our entire careers.
It's my entire career,
Yeah.
so I can at least say that.
Perhaps for many of us, right?
Yeah.
So, and I think you're absolutely right. We've been through good times. We've been through some pretty tough times as well, and
including a not so friendly divorce from another firm.
yeah. So I think because of that, it's given us perspective on how we think and how we may react to different situations. Now, I think when anyone brings something up, it's never a layup. There's always challenges. Everyone asks tough questions. Everyone challenges each other, and for an outsider looking in, sometimes they may seem a little bit confrontational. But really, what we're trying to do is we're trying to find if there aren't any holes in the thesis that one party has come up with, and ultimately, that's going to benefit everyone here.
I think we also have a very disciplined asset allocation process. Something we've been doing, even going back to the old firm, as far as we have now we have like 4 meetings a week where the investment team talks, but we make our asset allocation decisions about every month because that's when we get the data that we need, and I think that process has allowed us to maintain discipline, not panic and change stuff intra-month and things like that. So it's just kind of a stable process of looking at the economic data once a week that Sam and his team puts together, taking that, having the dialogue that Andrew's talking about where we can learn about what's going on in each other's sectors, and then come together and make changes on, should we decrease commercial real estate because of what's going on? Maybe we should increase it because the spreads have widened out and that's where the opportunity is. And that's just that process, staying true to your process, I think is important.
Yeah, I agree with that too, and I think that's what I've always noticed too is the challenging at the investment level, but then also you talked about the holes in the thesis. What about the holes in the thesis at the portfolio level? And that's something we're always discussing too. So Vitaliy, how do you think about your role then as someone who's kind of diversifying credit exposure? Because in simplistic terms, you're kind of a rates trade, right? You go as rates go. Yeah, there's some dynamics and ways you can do that. But how do you think about that and your role? Because we think of you more as a defensive player, or at least I do. As an allocator, I think of you as my defensive guy than my offensive guy. Now, obviously, in April, there was some crazy stuff going on in the mortgage market where we were playing offense through government guarantee that was yielding more than some credit markets, right? So how do you think about your role as a defensive player and how you integrate all of the ideas you're hearing from the folks around you?
So I think
it's the reason we put you in the middle too here.
Yeah. I should have been on the right now. So I think it's actually, perhaps it's going to summarize the both previous question and the question you're asking me right now is, what makes this work, right? We have all these diverse people, right? And we have all these diverse ideas. And I think it starts with a foundation, just like a house, right? Do you have a sound foundation? And I think that's what we have. We have processes and products that have been worked out over many, many years that have an underlying theme that allows them and qualities that will allow them to perform under certain environments. And each participant in this roundtable has a role in them, and you asked me about what my role is, right? So idea is that whether you're looking at the total return, whether you're looking at the flex, whether you're looking at any other strategy that we run, each particular sector has a role. So as you have alluded to, agency MBS typically will have an defensive role from the standpoint of providing rate support, as we've talked about, the qualities of the rate. But also you have an ability to generate alpha through, various things, difference in prepayments, like we've discussed with Ken about CMBS and so on and so forth. So I think what's important about what we do is we help to kind of unify everything together. We understand what risks Andrew has. We understand what risks Sam has, what Ken and Morris. And once you have that side of the equation, then you can put on the other side that defensive side. How many defensive players do we need? Do we need 5 or 20, right? Because, what structure do you have in place? What else do I need to do in order to be successful, right? Should I be aggressive or should I be, really defensive from this standpoint? So I think this part of the, or at least the way I view our group is an ability to put together this complete picture, complete portfolio that not only going to do well. A lot of times when the people say we hate credit, we don't. We just understand that there's cycles, right? Sometimes credit is cheap and you want to have as much of it as you want, and sometimes it's just rich and perhaps you should have none. Unfortunately, it's never going to be the case.
Right.
But
it's funny you say that because you say that there's this perception that we always hate credit, but we always own credit.
Yes.
It's just where we own it in the capital structure, where we own it in,
right.
And look, as a firm, we own more credit than we own rates today.
For
right?
sure.
And because that's thematically the trade we want to put on, right?
Yeah. So I think it gives you that unified framework where we know what we're going to use this portion of the portfolio for, as you said, liquidity, diversifier, something we can sell if hotels become cheap or whatever that story might be, right? So I think from that standpoint, each component, each piece has its own role, and we know exactly what that role is. So we can be wrong on CMBS or ABS or whatever that might be, but we're still going to be able to survive and claw ourselves out of this situation because we have an opportunity to take advantage then of the situation, right? I mean, if we're sitting here in December of last year, how many people thought that airlines would need a $50 billion bailout or whatever? Like, it's not something you can think about, although, some people claim they would, right? But then you have an opportunity to, live another day to get
dry powder. The agency portfolio is your liquidity and your dry powder and your safety when everything's going down. Usually rates are falling.
Yep.
And we can, even though the spreads were wide, they weren't as wide as credit. So maybe your agency mortgages were 2 points lower than you thought you would be able to sell them, but your credit was like 20 points lower.
But you could sell them. That's important. As you mentioned, you couldn't sell 25-year overdraft.
March of 2020 was the worst liquidity I think any of us have seen in our career. Because even in March of 2009, you could sell a bond. And we were selling in March of 2009, if you remember.
Yep.
And you may not like the bid, but you had multiple dealers, even though Bear and Lehman were gone by then. You had multiple dealers that would put bids on your bonds. In March of 2020, people were not picking up the phone. And part of it was like, that was the week where everyone was like, evacuating the offices and working from home and people weren't set up. And, guys on the trading desk and girls on the trading desk were getting taps on the shoulder saying, don't bid anything. Right, so I don't think we'll see March again. I think that was really unique.
Well, how funny. It was March of 2009, March of 2020, but we're never going to see the March again.
Yeah. There's another one coming.
To March, if we go back, there's a lot of bad things. So I think it's a very important point, though, too, because you're talking about price in the market, but we also had a disruption of just the mechanism of trading, right? I mean, that the fact that, people were from home, you can't have a sell side firm where you have a bond salesman sitting in the middle of the trader and everything going on, right? So it's getting used to that as well. So let's talk about the improvement of the market, right? What's happened? So I want to hear this from each of you. Sam, what is the market getting right and pricing right in the market today? And the converse, what do you think is a gross mispricing in your space?
The collateral underlying a CLO or corporate is corporate borrowing, so typically loans. I think as a firm, we've highlighted that the corporate sector is pretty leveraged up, and there's no denying that. The leverage ratios are high, even with if you want to use equity as the denominator, even with the equity component. That said, and so that's just a risk that is absolutely there. And then there's the risk, again, as we record this, we're in the middle of a pandemic. We think things are going to continue to normalize over time, but there's also, we've talked about it here, there's changes, some of which will probably be permanent. How much business travel will be going on a go-forward basis as a percent of 2019? I don't know the answer to that. It's probably not 100. Is it 50? Is it 75? I don't know what that number is. So that thing, I think, or that dynamic is a headwind for for our entire society, but specifically to our sectors. But also in the time since March, there's been a lot of borrowings in the corporate space. And so CFOs and other folks that make decisions on behalf of corporate America have seen and been given a chance to refinance their borrowings. The market's rallied. The Fed has backstopped largely investment grade, but that had an indirect effect over the entire market. So it sort of pushed out the potential risk. So I think in a way, the corporate America has bought some time to see if the recovery can get on track. At some point, if we're still sitting here with these on-off lockdowns for the next couple of years, unfortunately, hopefully that doesn't happen. But if that does occur, then we're gonna have to face the sort of reality of zombie companies. So I think when you think about the implied default rates for CLOs, and they're pretty low. I think the number, depending on what part of the capital structure, might be 4 to 6% on a go-forward basis. And then you have the rating agencies that sort of do the downgrades. I feel like that I think the risk is that number goes higher, but on average, I think that sort of feels right, largely because the borrowings have been sort of pushed out over time. So the big risk is the amount of borrowings in the corporate sector. What I think has been done right is that there's been a lot of refinancings that pushed out those maturity dates, and now I think it's really up to what happens in terms of the big picture and whether we get a vaccine and so on.
So as Ken said, it's kind of time on your side there is what you're hoping for in corporate America.
Yeah.
So Andrew, what do you think? Same question. What's the market getting right? What's the market getting wrong?
I agree with Sam's points, but I would say this. I think if you see riskier assets not seeing the rebound that they have, I think that's right. And the reason I say that's right is because there's so much still uncertainty out there, whether it's election next week, or the outcome of the election next week.
We're pretty certain we're going to have one, I think.
Yeah. Well, we're certain that the election,
Yeah.
just not the outcome, what that's going to look like. But and also COVID, right? I mean, COVID is probably taking a backseat to the election, but it's still very important. You see it, the outbreak and how it's affecting different economies around the world. That's going to slow economies down. And I think because of that, it could weigh pretty heavily on riskier assets, whether it's high yield, whether it's with mezzanine tranches in asset backs. I think that's right. I think that them not coming back at the pace that the seniors have come back, that is correct. Now, what are potentially people getting wrong? I think a lot of this discussion around, and this may be more macro than just on ABS, but certainly it does affect ABS, is this whole concept of rising inflation by just pumping the stimulus money into the market. I think there was definitely some concerns about that happening, but I really think my personal view is that if we can't manufacture growth through just pumping money into the market, we're not going to see that inflation. And I think anyone who's putting on that trade expecting it just through stimulus alone, I think they're probably getting it wrong.
Yeah, well, I've always viewed this crisis, or I have been viewing this crisis, is that the reason we haven't seen the inflation is because it wasn't stimulus. It was replacement of income, which is a different dynamic. You're not saying we're going to make new borrowings available for new projects and high money multiplier things. It's that we're going to give you money because you don't have a job, right? We're going to help you out. We're going to give you that safety net. And so that isn't stimulative too. So Vitaliy, same to you. What is the market getting right? What's the market getting wrong?
Yeah, I think this whole argument of inflation versus deflation is not necessarily what market is getting right or wrong, or some of the conclusions that are being reached because of that, right? And one of the conclusions is that rates have really no place in the portfolio anymore, right? We've talked about death of 60-40s and so on and so forth. And I think that's something that we have to be very careful about, because if we're wrong about the inflationary pressure that this particular stimulus, and we're talking about possibility of policy error, both fiscal or monetary. I mean, look at the second stimulus that hasn't been passed up to this point, and whether it's going to get passed or not, I know Ken mentioned it would, but I think it's going to be contingent upon the results of election. So point being that today's market is not necessarily the one where you're trying to go for the highest possible return. Today's market is, in my view, is all about the preservation of capital so that you can live another day. And I think that's exactly what mortgages or treasuries give you today. Is you're not gonna as you've mentioned, I think on a call yesterday, or last 6 months, they've done nothing for you, but they haven't lost you money either, right? There are many things that would have made you money. There are many things that you would have lost money on, and there is a very high degree of uncertainty as to what the winners are going to be, what the losers are. I mean, is it value, is it growth, all that good stuff? Is it ABS or whatever it might be? So I think people underweight the importance of that safety trade in their portfolio today, and particularly how you put that trade on, what it should be, whether it's going to be the steepener or whatever that story might be, right? But there's still a lot, I still think for the next year, 2 or 3, rates market will have a significant role to play in the portfolio. There is going to be a point in time when, output gap is covered, when, the saving glut is gone, when we, back to, and rates are going to back up significantly. And I think that's going to be the time perhaps where you might want to be a little bit more aggressive with, the growth side of the equation. But I think given the level of certainty in the economy, rates side of the equation still have a role to play.
Right. And well, that's something we always do when we build portfolios, is that we try not to be myopic or unidirectional, right?
Yes.
Try not to get focused on one thing, think it's the home run, but knowing that things hit you, they're exogenous shocks too, right? And sometimes our analysis is going to be wrong, right? We're going to miss something. So Ken, to you, what's the market getting right? What's the market getting wrong?
Yeah, I mean, I think the markets are forward-looking. So I think what's happened is that we're doing some can kicking down the road these days, right? It started with J. Powell Burr. He helped
The Burr.
he helped get the capital markets open, which allowed issuers to come back and issue debt, which now they're flush with cash, and everyone's hoping for the vaccine. So the market's kind of expecting things to go back to normal. But what if they don't, right? So if they don't, that's kind of that deflationary scenario where you want to own the agencies, you want to own government guaranteed debt. And we haven't been able to create inflation because we've just been increasing money supply, but it's not moving around. It's just kind of like sitting in the banks, right? So you look at M2's gone up, but money velocity has collapsed. I think I agree with Andrew that the stimulus doesn't create inflation unless there's a new kind of stimulus. And last week I had an interview with Bill Campbell, who runs our global bond group, and the one thing that's a hot topic in Europe right now is this CBDCs, not the cannabis oil, CBDs, that's popular in California here, but central bank digital currency, which is basically the central bank will give each of us a credit card, and then they'll wire us money, and we can go spend it. And that's it's kind of these wild card things that you don't really expect or think about. That's what the market's not getting right yet.
Yeah.
Right. And that could create inflation.
Right. And I was interviewing someone yesterday. We're on a media campaign, it feels like now. And this person was pointing out that why should Bitcoin run the world? Why? Because you lose the power of your sovereign entity. Why shouldn't the central bank control it? It's a good point, too.
And MasterCard is working with, MasterCard and PayPal are working and talking to the ECB. And the IMF just had a meeting where, these types of discussions 5 years ago, people would have not even showed up. Like, what are we talking about here? This is a joke. And now it's it's totally being considered.
But also during a crisis, what we were lacking was the transmission mechanism, right? We had Congress that was passing stimulative or just at least fiscal response, and it took time because that's to work its way through the banking system. But there are implications, you say there too. So Morris, what do you think about what's the market getting right? What's the market getting wrong today?
Sure. I would say, similar to Andrew's sort of thought process, and you said something that is fairly applicable to the CMBS market in a sense. Given the uncertainties surrounding the commercial real estate as a whole, given the pandemic, there is, with the right reason that, the bond prices are the way it is at this juncture. And I would say, from a market sort of pricing perspective across the curve, and even from a recovery standpoint on a year-to-date basis, you're definitely seeing, that reflection that there is uncertainty in this market, right? Like whether, triple B bond or a mezzanine bond is trading at 5 or 6% yields, comparable to, some of the, even wider than, high a double B high yield bond by way of example, and or within the CMBS market, and or areas in my area where AAA bonds off of hotels are yielding 3% or 4%. That's AAA, right? And it should be money good. But with that said, there is that what brings us uncertainty brings these type of prices, and I would say you can't say that the market's wrong on that. I think the market's right, but that also brings opportunity for us if you do the homework correctly. Now, where as we're thinking about the commercial real estate world, the wrong side, the Fed pumped in a ton of liquidity into the system, brought rates down to a significant level where it does influence investor to want to take more risk and get more yield, and that was also in a compressed sort of time frame. And even for us, as we're talking about commercial real estate, Vitaliy, you made a point earlier this week when we were talking about it. He reminded us that everyone, hey, we're in a recession. Right, and sometimes the markets doesn't trade that way.
Yeah, but GDP's up in the third quarter, right?
We're booming.
Biggest ever.
Biggest ever, but we're still 3.5% to 4% off the highs, which
Exactly.
is typically a horrific recession. I know there's some controversy about that. I saw that on a lot of blogosphere and Twitter this morning, where people are going, "Well, it's only off 3%." Well, 3% is usually a huge recession.
That's
when
the
you
08,
decline.
09. That's
Yeah,
the 08, 09.
That's right. Go ahead.
And these type of dialogues, I mean, the construct of, hey, we're in a recession brings everyone to a reality check, right? Like I'll use one deal by way of example. This just came out. This is in the market or currently in the market, and from a risk standpoint, you have weaker loan covenants relative to even pre-March. You have a commercial real estate portfolio of commercial real estate properties that are in an area where I would view as a ground zero for degradation of fundamental performance, whether it's rents or vacancies. But you have one strong standing peg that that every investor is looking at is, oh well, look at the LTV, look at the loan to value of this asset, right? Like, let's just ignore all the loan structure, ignore who the borrower is. With LTV is X. And the biggest problem in the commercial real estate world is that V is very subjective. It's a lot of assumptions. You could probably stick your finger in the air, and you need to be very careful. And under this construct, this was a refinancing. So the borrower is taking cash out. You're giving him the best structure in the world, loan structure and loan covenants in the world, and you're asking us, asking investor community to pay a price that is very expensive relative to what you can find in the secondary. And the fact that your people are able to bring this deal out, rationalize this investment, goes to show the type of risk taking that's in the market today, right? And for us, the way we're thinking about the world, you're not getting compensated for it. The upside and downside doesn't make much sense. And from a leadership perspective within the market, you can't support that type of behavior. That's the challenges of the market. I feel that oftentimes people forget where we are in the cycle. This is a pandemic. There is a lot of uncertainty.
It's not just a recession; it's a recession and a pandemic.
Right. And
But remember, the stock market's up, and so that's what a lot of people think. Like, oh well, my corporate bonds are up, stock market's up, everything must be fine, and it influences thinking, right?
Exactly. And that's the angle I'm coming from. Is there are areas where the market's doing the wrong thing. You can't just think about yield in a low yield environment. Sometimes a yield isn't enough to compensate you for the type of risk you're getting. Right?
Okay, so on that note, Morris, what I wanted to kind of end this with, we've been talking about structured products, talking about a lot of the benefits out there. I want to give each of you a platform to say, there's some misconceptions about the structured product space, right? What do you think one of the largest misconception is, and how would you refute that argument? Sam, you want to kick us off there?
Yeah, I mean, I alluded to it earlier. I think it's the association of the 2008 subprime crisis and just saying bad, subprime bad, therefore anything CDO, MBS, whatever is associated with that. And I think a lot of investors fail to see this as a very large market. And in fact, what happened at that point, back 10, 12 years ago, you can have a conversation about it. And there's reasons why that happened. And structured finance in general provides a lot of opportunity. And I think as a bucket, there's always opportunity to outperform the rest of fixed income because a lot of investors don't have the the understanding to sort of invest there, or it's a difficult sell. You won't see a family in middle America buying a mortgage-backed security, although they will buy a corporate bond. So I think that complexity and the association with 2008 crisis is sort of still lingers, and I think that's something that we try to take advantage of, actually.
Yeah, I think it's interesting. People say, well, it lost money, I don't ever touch it. But you buy stocks that go to zero.
Yeah, exactly.
You buy bonds that go to zero, right? And corporate bonds. So, Andrew, what do you think one of the biggest misconceptions is?
I mean, I'm going to be boring and go back to one of the first statements I said. It's in terms of transparency. Everyone thinks that corporates or other assets are more transparent than structured products. And it kind of touches on Sam's point about complexity. Really, if you look under the hood, you have everything in front of you, and you can do all of your work, and that whatever's under the hood will not change over the life of that transaction. So my point would be that this is more transparent than most other asset classes.
Yeah. I think of that when you told me that years ago. I think I draw the story to like gold miners, right? Like gold miners are some of the worst run companies out there. You have a production cost today of gold in the low like $1,000 range, kind of marginal cost of production. Got $1,900 gold, and they can't make money, right? So that's a joke, of course, but they are making money in some capacity. But you're right, management can screw you up in corporate America.
Or they just
like
change things, right? They just change the direction of it, and what you're in 10 years ago is very different than what you are in today.
No, good point. Vitaliy, what do you think the biggest misconception is?
Yeah, I think some of the heuristics that people use to describe various subsets, and I think it kind of goes back to the complexities, but I think it's very easy to file something away with one word, right? I mean, well, agency MBS, negatively convex, okay, we're not touching this, this, that. But there's so much depth about each sector, and I'll give you an example. We run very large portfolios which are actually positively convex with respect to agency MBS. So once you have discussion with investors, once you explain the features and characteristics that exist within each sector or subsector that we all talk about, there's quite a bit of difference between what the initial perception was and what the actual reality of the particular subsector is. And I think it goes back to some of the things that happened in 08, 09, although we all had a corporate crisis in 2001 and 2, and
nobody cares about that.
Nobody cares about that, right? And we had
well, you had a 94 crisis, right, in mortgages, and no one wants to touch CMOs for that reason, right? And that was 1994.
And by the way, there weren't even the agency or mortgage CMOs that were muni CMOs, right? But let me not bore you with that stuff, right? So point being that I think there is not enough education about what is on offer within the structured products, and hopefully through this kind of formats, through this kind of discussion, we can tease out certain things that, again, not everything about it is great, right? It requires specialized attention. That's one important thing about. Maybe that's the biggest truth about what this thing is, right? When you guys said, well, it's not as complex, yeah, to you. You've been doing it for 20 years, right? So maybe, yes, it's not as bad as the perception is, but it does require special attention. It does require the team of people who've done this for a bit. They just didn't start it yesterday. It's not a tourist kind of environment. But once you have those requisite kind of foundational pieces in place, it's actually very attractive space that has some characteristics that most investors can utilize and benefit with.
Yeah. No, I think that's fair. And as I told a lot of investors in the April kind of reviews on the first quarter reviews and the panicked investors is that, again, we're not epidemiologists, but one thing we can do is we know how to stress cash flows, right? We know how to analyze cash flows. We know how to apply some kind of reasonable assumptions, some draconian assumptions, and tease it out and say, okay, what makes this work? What makes it fail, right? So Ken, same to you.
Yeah, I'll build off what Vitaliy talked about. Everything that people have said, I would emphasize that even more because mortgages were the epicenter. So can't tell you how many meetings you walk in and people are like, oh, these evil mortgage people are back in here trying to sell us subprime mortgages. So, but that actually, because that happened, it's made the sector better because of better underwriting quality, skin in the game with risk retention. The rating agencies have gotten more conservative. But to Vitaliy's point, it's not a tourist market. You can't just come in and kind of buy a basket and do what we do. Like there's probably like 70% of the agency mortgage market we don't even look at because it's at a big premium off high coupon mortgages, and it's not giving us what we want out of it. So what I like to tell people is so interesting about securitized products is you can go get the different kind of factor exposures that you want. Do you want long duration? We can give it to you. Do you want short duration? We can give it to you. Do you want floating rate? Do you want fixed rate? Do you want inverse floating?
Right.
Right, and I can
which blows people's minds, right? Yeah, right.
So you can create a portfolio or a part of a portfolio that will do well in certain environments, rising rates, falling rates. If you are coming out of a recession and spreads are wide, I can take more credit risk. Maybe I want to take more corporate credit risk, so I'm going to buy CLOs. Maybe I want to make a play on the commercial real estate market. I can buy CMBS. If I want to play the strength in housing, I can buy, or the consumer, I can go to pockets of ABS and the RMBS market. So you can look at the broader economy, you can look at your view on the direction of rates and credit spreads, and you can create a diversified portfolio that can, outperform other parts of the market potentially. Right? Agency mortgages for almost half a decade, I feel like from 2013 to maybe 18, they weren't that interesting because the spreads were just so tight. And then now it's probably one of the most interesting things to talk to with investors because the spreads are like on top of corporate bonds with way less interest rate risk. And if rates do rise, they've been rising, it's going to do significantly better than corporate bonds. So I think
no credit risk. Let's just start there.
Right? No credit risk. So,
right, same spread, no credit risk, right? Yeah.
Yeah. So I think with a skilled manager that has experience in the market, you can't just rely on the models. If you look at the models, they would have told you to not buy non-agency mortgages in 2009, right?
Absolutely.
Because everything was going to default because you're extrapolating the past. So you have to add the qualitative aspect, bring the human and our experience to be able to say, okay, the market is being too extreme. This is the time to buy, which is kind of, certain securities in March. We had to do that analysis. We didn't know it was going to happen, but we have to say, okay, it's probably, even if things get XYZ bad, this bond will probably not take a loss and it's trading at, let's say, 80 cents on a dollar. Let's buy this, right? And that takes the collective knowledge of the team, having worked through many cycles to do things like that.
Yeah, Morris.
Sure. Having
you get stuck in the position they've said it all, so you got to come up with something unique.
Exactly.
Yeah.
So I would say first off, agree with everyone in terms of the language surrounding structured products as a whole, in terms of conceptions and misconceptions. The way I kind of look at the world within structured products also is, parts of structured products is part of the index. And when I say the index, Barclays Ag, and it's simple for fixed income investors to think about the Ag as, what's representative of the fixed income world in itself. But as you kind of dig into it, there's CLOs, by way of example, is not part of the Ag. It's not although bits and pieces of underlying CLO credit is within the Ag, but just because it's not part of the Ag doesn't mean that you should skip over that sector as a whole. And some firms don't invest in that area because it's not mainstream. And I think what our platform and our group and our firm as a whole is, we think and we have found value and proven over the years that there's a risk premium and or a liquidity premium that we're extracting from trafficking in this space, whether it's ABS, whether it's CMBS, whether it's RMBS, different areas of government guaranteed bonds, and it's that sort of misconception that it's a small sector, it's not part of the Ag. I think that's important to kind of point out. As an active manager, we can find or alpha effectively within a variety of market conditions, structure through structured credit. I think that's one sort of given point that kind of point out. CMBS it's a $600 billion market relative to the corporate market. It's a lot smaller, but it's $600 billion in a market where where from a average yield or spread pickup versus a comparable corporate credit bond, it gives you a lot of tools and investment opportunities to pick and choose where you want to be, and that excess spread over time is what's unique about structured products. You can pick up these excess spread without having to be within the traditional fixed income sectors.
And I'll add
what
on
about
to
you,
that.
Jeff? You manage portfolios here. Why do you like structured products in your portfolios?
Well, one, it's a diversification thing that everybody tapped on. Secondly, in the current environment, the less interest rate sensitivity I think is very important because you don't have to go out. The corporate bond market, and we haven't really addressed this, but the corporate bond market has more duration or interest rate risk than it's ever had today in the U.S., and that's a testament to what Sam said about corporate CFOs being smart, issuing, refinancing, extending out maturities. And so it gives us a way that we don't have to take an incremental risk, right? If I buy a corporate bond today, I encompass default risk, and I get this interest rate risk that I didn't maybe not want, right? And as Vitaliy reminds us, that the corporate bond doesn't give you that same safety on that duration risk that you take. So it's ways of putting this into your portfolio as an asset allocator. I think it's very important to have more tools. And the one thing about the fixed income market is that there is a lot of diversification across sectors. And so it's not just the Barclays Ag, as you point out, Morris. There are these other kind of risks that you can take out there. And so whether it's a prepayment risk, whether I'm taking consumer-linked risks through mortgages or through asset backs, the asset-backed market, I can get corporate risks too, right? So what I like about it is that it's another exposure. We're all mathematically trained here. We all think about factors and how these exposures interact with one another. And the one free lunch out there is diversification, right? That's the one thing you can get through a cycle is diversification. And one thing I always think about, and that's when we talk about our risk integration, and that's what you've been alluding to, Vitaliy, is also just how we can buy offsetting risks. We're not hedging, right? We're buying risks that blend together, and they both are positive carry. I get yield on the one trade, I get yield on the other. If I short rates, right, I have to pay for that. I have to pay that coupon to the person I'm borrowing from. So that's the thing I like about the space. And in this environment, there's a reason as a house we're very overweight this sector of the market because, again, the credit profiles look good, the cash flows look good. Yes, there's some risk out there, but that interest rate component is dialed down in the space relative to the other pockets. So with that, did you want to take us out, Ken, or should I do it as well now?
I wanted to get you included.
No, absolutely. So that's the kind of camaraderie we have around here, right? We all like to have this banter. So I thank everybody for paying attention to the Structured Products Roundtable. Hopefully you found it engaging and interesting. Hopefully you learned something along the way. And as always, if you have questions, feel free to reach out to the DoubleLine team. We'll continue to bring you more of these roundtables as time permits and ideas come to fruition. But we thank you for listening and thanks for your interest in DoubleLine. Take care, everybody.